This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh. In today's video, I wanted to talk about Oceania Healthcare and its recent share price performance. I'll be going over some of the news that I think has resulted in Oceania's share price to drop consistently over the past 3 months. We'll be comparing it against the performance against its peers as well. And I'll be sharing with you what I think of the entire situation and what I'm personally doing. So if you enjoyed today's video, be sure to hit like and subscribe. And if you're watching this from Australia, Sharesies recently had opened up its platform to Australian investors. So if you're looking to buy New Zealand stocks, check out Sharesies using the link below. You get $10 when you use that link to sign up. And if you're looking to buy US stocks, recently I have signed up with Interactive Brokers once again as they've removed their inactivity fee. If you want cheap FX fees, definitely check Interactive Brokers down below, but I'll be doing an update on them soon. So time to get right into today's video. Oceania Healthcare, that's what we're here to talk about. As you can see, Oceania Healthcare currently trades at $1.29 New Zealand per share. And as you can see, over the past few months or so, Oceania's share price has dropped by 17.83% since the end of August. So there's been a consistent drop in its share price, which definitely has left some investors out there worried. Now, if we look at Oceania Healthcare's performance versus its listed peers such as Aveda, Ryman, and Somerset, Oceania has performed the worst if we look at their share price performance from the start of August. So you can see Oceania's performance is a negative 14% return versus Aveda, which returned negative 5%, and Somerset and Ryman, which is around the 3 to 4% mark. Now you can see I've added a light blue line over here, and that is the NZG fund. The NZG fund closely tracks the NZX50, so this is used as a proxy to show how the index has performed. And you can see that Oceania Healthcare has severely underperformed the index performance and also severely underperformed its other listed peers. So in order to understand the recent share price performance, I've looked at news going back to the start of August, and it all starts with this little dip over here in mid-August. In case you don't know, if you're not from New Zealand, this is when New Zealand moved into alert level 4 as a result of the Delta variant entering New Zealand. So New Zealand entered into lockdown on mid-August, and subsequent to that, a lot of New Zealand actually moved out of level 4 quicker, but Auckland stayed at alert level 4 for quite some time, and currently we're in alert level 3, which means there are still some restrictions in terms of gathering. However, most of New Zealand now is in level 2. So if we look back at this minor dip over here and understand that the lockdowns have been extended for much longer than what people expected, looking in hindsight, we can understand now that this minor dip over here was probably too little of a dip considering what has transpired. So now we're looking back and we're seeing, okay, that dip was probably too small, and what's happened now is that the market has slowly reflected that the lockdowns have a much more severe impact on the industry as well as on the New Zealand economy. And that's why we're seeing now the share prices for these retirement village operators come down quite substantially. So that is my opinion as to why this little dip is very important, because it kind of sets up the share price performance for the coming few months. So let's take a look at some of the impacts of the lockdowns. So the first one is that lockdowns restrict the ability for new residents to enter to facilities, and construction activities as well delayed under level 4. So when you can't build, you can't sell new units, meaning less profit for these operators. Thirdly, there's also an increase in operating expenses related to safety PP&E as well as higher staffing demand. So I'll talk more about this later on as to who it impacts more in terms of these operators. And lastly, lockdowns restrict the ability to sell homes. So usually when an incoming resident moves into a village, they would sell their family home or the home that they're currently living at in order to fund the deposit needed to move into these retirement villages. Now, as we can see over here reported in the REIN's October monthly report, in Auckland, it took 15 more days than the same month last year to sell your home. However, if you look at the rest of New Zealand, that's not so much the case because it only took 1 day more than the same month last year for New Zealand, excluding Auckland. The retirement village operators that are more concentrated in Auckland will have a bigger impact, and Oceania has 44% of their units built in Auckland, so that's a very high concentration compared to other listed peers like Ryman, which has 33% in Auckland, and Somerset that has 26% of units in Auckland. So from a portfolio perspective, Oceania will get hit the hardest compared to the other listed peers. Now I want to go back to increasing operating expenses because Oceania Healthcare as well gets hit the hardest over here. So this is information that I've got from analyzing how the previous COVID impact in 2020 affected these listed operators. And as you can see, what I did was I took the average assets in the balance sheet divided by the costs incurred as a result of COVID. And as you can see over here, Ryman has incurred a pretty high cost of 0.5%, but in second place is Oceania Healthcare, incurring 0.42% of their average assets in COVID costs. On the other hand, we see Aveda and Somerset having a ratio of about 0.25. So they incurred about half the cost of what Ryman had incurred, and this has to do with the portfolio composition as well. Oceania Healthcare and Ryman Healthcare have a higher weighting of their portfolio towards care, whereas Somerset has a higher portfolio weighting towards independent living, so they don't have to incur as much operating expenses or incur even more as a result of COVID. Now, in terms of the lockdown dates, obviously the Labour government can't give any certainty on the lockdown date at the moment, and the longer this goes on for, the longer that the share price performance will be affected, in my personal opinion. So this has to do with sentiment. At the moment, sentiment in the industry is very negative as a result of the uncertainty due to the lockdowns. Another reason why Oceania share price has dropped quite substantially is because Aveda had a huge capital raising in mid-October. Aveda announced that they were acquiring Arena Living's retirement living portfolio. In order to fund this purchase, Aveda had raised 155 million of underwritten placement and 175 million underwritten rights offer. So all up, that is about $330 million, which in New Zealand is quite a large amount. So in order to raise that money, they had to draw money from the shareholders as well as from institutions. Now, it's very important to note that in the underwritten rights offer to retail investors, this amount was actually undersubscribed by about 25%. So what this tells me is that retail investors actually don't have very much cash lying around to take advantage of the rights issue. So an implication of that is that shareholders that have shares in the retirement village operators might have to sell their shares to actually participate in the rights offer of Aveda, because at the moment there's a mantra going on that cash is trash. So a lot of these fully invested individuals might have to sell stocks in the other retirement village operators in order to fund this rights issue. So in my opinion, this would disproportionately affect Oceania Healthcare, because Oceania Healthcare is probably seen as the closest comparison to Aveda in terms of size. Now, another piece of news that might have affected the entire industry performance is that there was news of staff members testing positive at a West Auckland rest home. So 2 more staff members, bringing the total to 4 employees at Edmonton Meadows Care Home in Henderson, had caught the virus, as well as 8 residents tested positive for the virus as well. So the total number of cases in this rest home is 12. So when the market receives news like this, it would obviously extend their fear, because they would think that the virus could potentially also enter into these listed retirement village operators. So it's very important to note that this Henderson village is not associated to any of the listed companies out there. I would say that this is mostly fear, because the chances of you catching COVID outside of a retirement home is probably higher than the chances of you catching it inside a retirement home, because retirement homes are known for very strict COVID procedures, so they wouldn't just let anyone in and out of these villages. So chances are you're safer in the retirement village. Now, there's another piece of news that I saw in the media that could potentially have an impact on the share prices of these retirement village operators. So in this article over here, it says that MPs have passed a law to make older migrants and New Zealanders who spend large portions of their lives overseas wait longer to qualify for New Zealand Super. Currently, New Zealand Super is paid to people aged 65 or over who have been resident and present in New Zealand for 10 years after the age of 20, with 5 of those years after the age of 50. The amendment bill, which passed its third reading on Wednesday, will see the qualifying period rise from 10 to 20 years, with 5 of those after the age of 50. The increase from 10 to 20 years would be phased in, and with the transition having been delayed until 2023 after protests that older migrants were being given too little time to prepare for the changes. Now, to give you some context, New Zealand Super for a single living alone is $436 a week, and couples up to $672 a week. So this is actually quite a large amount of money that these individuals are receiving. Now, this would impact Oceania Healthcare the most, in my opinion, because Oceania Healthcare provides a premium offering. And when you have a premium offering, this usually isn't covered by the normal government subsidy, the aged care subsidy, which is about $900 to $1,000 a week depending on your location. And if these incoming residents get their super delayed, then we might see an impact on these retirement village operators, disproportionately affecting those that have a premium offering such as Oceania Healthcare. Now, personally, I don't know what the impact of this is on Oceania Healthcare, given that Oceania has a minimum entry age of 70 years. So if someone moves back to New Zealand by the age of 50, then they would be able to make it in time by the age 70 to qualify for their super. As well as that, there is a delay, obviously, to 2023. So this gives some returning Kiwis some time to figure out when they actually need to come back. So in my opinion, this would have a minimal impact, but it'll be interesting to monitor this situation. Now, there's other reasons as well, such as a cooling property market that might have caused the share prices of these stocks to come down quite a bit. As you can see, home loan mortgage interest rates have increased, and what that does is it increases the cost of borrowing. And when you have a cooling market, it will also indirectly affect these retirement village operators. But with Oceania having a larger percentage of their portfolio in care offerings, they wouldn't be as much affected as other operators such as Somerset. So this is something to keep note of. But by far, in my opinion, the largest impact on the share prices of these retirement village operators has to do with the 10-year New Zealand government bond. So the 10-year New Zealand government bond yield has increased from about 1.6% to close to 2.6% over the past 3 months. So that's an increase of 1% over the past 3 months. And when interest rates rise, this usually has a negative correlation to share prices. So when interest rates rise, share prices come down, PE ratios contract. So over here, I have a chart showing the relationship between the S&P 500 PE ratio and the 10-year US Treasury bond yields. So the reason why I'm using this chart instead of the NZX 50 PE ratio chart is because information on the NZX 50 is very hard to find. So I'm just using this to show you the relationships between interest rates and share prices. As bond yields go up, you can see the P ratio comes down. As an example, the NZ government bond yield 3 months ago was sitting at roughly 1.5%. And over the past 3 months, it's increased by 1%. So an increase from 1.5% on the US Treasury bond yield to 2.5% will see the P ratio drop from about below 25 to below 20. So that's about a 20% drop or 20% contraction in the PE ratio. So in my opinion, this is by far the biggest reason as to why the entire industry has been dropping quite substantially, as well as the NZX 50 not really doing very much over the past year, and in fact is in negative territory year to date. And the reason being is, of course, interest rates are increasing. So it's very important to remember under times like this of the fundamentals of investing in a stock like Oceania Healthcare. So in my mind, these are the fundamentals. There is a huge aging population, increasing the demand for aged care and retirement village living. As well as that, the business model is very tax and capital efficient. Oceania Healthcare in particular has an NTA backing of $1.20 per share. In addition to that, we should expect revaluation gains as the property market has gone up by around 25% over the past year. In addition to that, they also have plenty of dry powder for further capex as well as acquisitions. Remember, Oceania Healthcare recently raised $100 million for 3.3% per year for the next 7 years. So that is a very cheap source of debt, and definitely they'll be able to return a higher than 3.3% return on their investment. So for me personally, what I'm keeping a very close eye on is how their care strategy execution is going. So management is currently transitioning the portfolio into a more premium care-based portfolio, which should result in higher DMF fees going forward. So it's important to see whether the care side of things are ramping up, especially heading into the next half-year result announcement, which would be on the Monday morning of the 29th of November. So personally, I have bought more Oceania shares in my private as well as in my public portfolio. So I'll give you guys an update on that at the end of this month, and hopefully we can break down the results for the half year for Oceania as well. So thank you guys for watching this video. Hopefully it was helpful and calmed the nerves down. If you enjoyed it, be sure to hit like and subscribe, and make sure you check out the links down below. That will greatly help me continue doing what I'm doing here on YouTube. So thank you guys for watching. Until next time, take care.